European markets have had a solid start to the year amid uncertainty in the United States. But does the trend higher have more room to run? Joining us now to discuss is Michael Brown, Vice President, Director, and Portfolio Manager with TD Asset Management. Michael, thanks for joining us today.
Thank you for having me.
All right, well, so there's lots happening in the world. Let's start with what's going on in Europe, where we're seeing a lot of money flowing into European assets. What's playing out there?
Well, I mean, it's been going on now for a few months with increased money flow into Europe, increased interest. We've talked for years about the significant discount valuation in Europe, and some of that gap has closed year to date, which is positive for European performance relative to the US. And it's really, there is some fundamentals driven there, but there's also less risk, less uncertainty. I mean, they will feel the effect of the tariffs, but the policy, they're uniting as Europe as one. There's potential for fiscal stimulus as well, and really coming together to hopefully make Europe more efficient and more prosperous, and investors can benefit from that.
Okay, so let's talk about countries in Europe, like Germany, who are looking to beef up their defense spending. What impact is that having on European stocks?
Well, the European aerospace defense space, I mean, has been up roughly 40% year to date and 60% over the last year. It's by far one of the strongest performing spaces in the market. This really stems almost from President Trump 1.0, where he was criticizing NATO members, including Germany, France, and many of the European countries, of not contributing a meaningful percentage of their GDP to defense spending. What has happened between Ukraine, between all current events, that GDP, as a percentage of their GDP spent on defense, is increasing across the board, which is positive for defense stocks. They're still well below what the U.S. spends, so there is a significant ramp to go, and even to hit the NATO target. So this has created a tailwind for that space, which has been positive.
Oh. All right, let's talk about European banks. How are they looking so far?
Well, European banks have been outperforming for a number of years. Really, what we've seen here has been a positive inflection in terms of profitability. After many years, well, basically since 2012, of negative interest rates, having positive negative interest rates with a levered vehicle like a bank, that's a significant inflection in profitability. At the same time, they have meaningful capital returns and still quite reasonable valuations relative to their return on equity, which has been expanding as a result of the rates. I mean, where we're seeing, we've probably passed peak rates in Europe, but they're still maintaining profitability, and there's no signs of return to negative rates, which is good for the banks.
Okay, of course, Japan is another region that faces headwinds from U.S. trade policy. There's still not a trade deal announced between Japan and the United States. And there's some commentary out of the Japanese central bank that caught your eye. Why don't you walk us through that?
Yeah, it was striking. The Bank of Japan came out with their April statement where they guided down like basically inflation, partly because of oil prices, because they import oil, but also just really played down the economic growth out of the Japan region and the actual effect of the tariffs. It's largely an exporting nation, so large auto industry, vulnerable in terms of autos to the U.S. It's a large market, obviously. But it was striking where they had talked about measured response to this, continuing that it's still positive growth and positive inflation in Japan, which a couple of years ago would have seemed impossible. So even with guiding down, it's still somewhat positive.
And what could be the outcome of trade negotiations with the United States?
It's an interesting dynamic. I mean, you look at, there are exporters, like a name like Suzuki that's 100% for export, or Honda, which produces in Canada, or Toyota, which could move production to the U.S. because they have large production. It really is the autos industry that would feel the brunt of that. And so the negotiations are important. The fact that at the same time we've seen the Japanese yen strengthen from 165 per dollar to roughly around 140, which is more of a normal long-term rate for that. So there is some yen strength headwinds as well for the economy, which is bizarre because they're an exporter.
Okay, now you also said that Sony is an interesting example of how these trends are playing out.
Well, Sony is an example of a longer-term trend that's been positive for Japan, which is a change in governance. So Sony, as we know, is a consumer electronics leader. PlayStation 5 would be their main product. They've had some success in terms of tariffs passing through price increases. But it's also, what's more interesting is a change in governance practices that's been taking place in the broader Japanese market, where Sony albeit largely known for consumer electronics, also has a financial operation, also has a semiconductors business. So they're spinning off their financial business in October, which is positive for shareholders, focusing on their core business. And then this week, they've been talking about recently to divest of their semiconductor business, which is also positive. It really is a step change in shareholder friendliness, and Sony was one of the holdouts, but for them to adopt it, I view as positive. So.